Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the first quarter of 2023, and that stock is Tesla. Now we can see over the last year, Tesla is down 34% in the same time period that the S&P 500 is down 3%, but they are dominating the market over the last 5 years. They're up 781%, while the rest of the market is only up around 50%. So in this video, we're going to look into some of the recent news that came out surrounding Tesla, a little bit of which contributed to their recent downfall in their share price. And then we're going to look into their financial statements to look at their revenue and earnings growth. And then lastly, finish off the video with a discounted cash flow model to figure out the intrinsic value per share for Tesla so we can know if this is a good price to buy into the stock from a value investing perspective. And so to start off, we have a really interesting article here that talks a lot about where Tesla currently is, along with some of the growth initiatives that could contribute to their growth long term. It's titled Stock Plunged 15% in April, but here's why that's a long-term opportunity. A couple of the key points I start off with are that the interest rates right now are elevated and a lot of consumers are shying away from electric vehicles because of their high costs. But that's a short-term problem, and the electric vehicle industry is set to benefit long-term from a lot of up-and-coming events. Tesla stock is down 60% from their all-time highs, but that could spell opportunity for long-term investors. They point out here that, first of all, Tesla is the global leader in EV production and sales. Their EV production is at a higher gross profit margin than any of their competitors. And even though the current economic climate is very difficult, Tesla decided to slash the prices of their EV vehicles in order to contribute to increasing demand, which sent their gross margins lower in the first quarter of 2023. And as a result of this, their stock had a negative reaction to this when they released their earnings on April 19th, and it closed the month with a 15% loss, and they're down 60% from their all-time high. But here's why that might be an opportunity. They point out that right now, consumers are grappling with soaring inflation and rising interest rates, which have been happening for the last year and a half now. And so as a result, a lot of more luxury good items, which might include EV vehicles, have been cut from household budgets. There was a study that pointed out that 47% of Americans are unlikely to buy an electric vehicle as their next car, and 19% of the 5,000 respondents that were surveyed said they were extremely likely to go for an electric vehicle the next time they were in the market for a vehicle. 83% of the people who were surveyed said they were unlikely to buy an EV because of the cost factor. So basically, they're too expensive for them. And so with that in mind, obviously Tesla cut the price of their EV 6 times so far in 2023, which sent their gross profit margin falling lower from 29% a year ago to 19% in the first quarter of 2023. But Tesla is able to do this as a result of the fact that they are currently the only profitable manufacturer of electric vehicles, and so they are able to afford this cut in their prices and able to have a little bit of a price war and put some pressure on their competitors like Ford and General Motors. Right here, they point out that the EV industry is a long-term story. A couple of up-and-coming events that might contribute to Tesla positively growing in the future include the fact that the US and Europe intend to ban the sale of cars that run on petrol and diesel by 2035, which will spark a transition to electric vehicles. Also, the cost of manufacturing EVs will come down as they achieve scale. Global electric vehicle production could soar from 7.8 million units in 2022 to 60 million units by 2027. And CEO Elon Musk said that he believes the company will be producing 20 million vehicles by 2030, which is up from the current 1.8 million estimated vehicles this year. And lastly, they point out that if history is any guide, gas prices in the future will continue to rise. And so as a result, owning an electric vehicle will become cheaper and cheaper and more convenient than owning a gas-powered vehicle. And the Biden administration wants to see 500,000 public charging stations in the US by 2030. And just to give that some perspective, there are currently 145,000 gas stations in the country today. And so if they are able to build out 500,000 public charging stations and the cost of owning an EV becomes cheaper as gas prices increase, there will be more and more incentive to transition from a gas-powered vehicle to an electric vehicle. Also, they point out some product development here. 4 years ago, it took roughly 40 minutes to charge an electric vehicle to drive 200 miles. Today, it only takes 15 minutes, and that could drop to 4 minutes in the next 5 years. On a valuation basis, right now Tesla is trading at a PE ratio of 42, which is still a premium compared to the Nasdaq's 27 times earnings on average PE ratio, but it's significantly lower than the company's PE ratio of over 1,000 back in 2021. So they could be trading at a much better buying opportunity right now than they were in the past. They are also right now the leading producer, obviously, of AI-powered self-driving software, and this can contribute to an introduction to the autonomous robo-taxi business sometime in 2024, which would also contribute to growing Tesla's business. And lastly, to end off the article, they point out that Tesla is not just an EV company, they also build solar and battery storage products for residential homes, and the demand for that is also soaring. In the first quarter of 2023, the amount of battery storage capacity deployed climbed by 360% year over year as the company's production capabilities gradually caught up with supply. Also in 2027, Tesla could be introducing their Optimus humanoid robots, which would integrate easily with the AI software they built for their autonomous vehicles, and this could contribute to some low-skill jobs in manufacturing. So even though in the short term, the opportunity for Tesla is the EV market, and that market alone has a lot of potential, with that said, it might not even be Tesla's only source of revenue, as they have their residential homes, battery storage units, their EV charging stations, their Optimus humanoid robot, their robo-taxi business, along with a lot of other initiatives that Tesla could take advantage of in the future. So definitely a really interesting article pointing out some of their future growth initiatives, as well as where their company is now and why it could present a good buying opportunity at the moment. And so right here, to get into their financial statements, this is their balance sheet comparing the first quarter of 2023 to the fourth quarter of 2022. Total assets are up from $82 billion to $86.8 billion. And then we can see that total stockholders' equity is up from $44 billion to $48 billion. Retained earnings increased from $12 billion to $15 billion. So they definitely have a little bit more capital now to play around with and reinvest back into their company. Right here on page 5, we have their income statement comparing the first quarter of 2022 to 2023. Total revenues during that time period increased from $18.7 billion to $23.3 billion. Keep in mind, this is an increase in spite of the fact that they cut the prices of their EVs. So obviously their cost of revenues increased faster than their revenues, decreasing their gross profit margin, as the article pointed out. And that contributed to a decrease in their bottom line and net profit margin here, decreasing from $3.2 billion to $2.5 billion. So their revenues increased by around 24%, but their net income decreased by about 24%. Also, although it's not listed on this income statement, Tesla produced 440,000 vehicles in the first quarter of 2023, and they delivered around 422,000 vehicles. So a lot of vehicles produced from their manufacturing line. The revenues increased, but their net profit margins decreased as a result of Tesla cutting the price of a lot of their EV vehicles, putting a lot of pressure on their competitors, as the article pointed out. And then lastly, right here, we see their cash flow statement for the first quarter of 2022 compared to 2023. Operating cash flow decreased year over year from $4 billion to $2.5 billion. And Tesla obviously does not pay out dividends, so we don't have anything like that in their financing activities right here. They do use a lot of their cash to reinvest back into the company. And so right here, we have a discounted cash flow model to figure out the intrinsic value per share for Tesla. Yahoo Finance estimated that the company is going to grow at around 5%, or around 10% for the next 5 years, compounded annually. So I was conservative and cut that in half to 5% for the next 5 years after that. They had $7 billion of free cash flow in 2022, with around $16 billion of cash on their balance sheet after subtracting their debt, and 3 billion shares outstanding. That puts their intrinsic value per share at $43 per share, which compared to their current share price means that according to those growth estimates from Yahoo Finance, Tesla is currently not trading at a good buying opportunity compared to their current estimated intrinsic value per share. And then on the right hand side here, I want to compare them to some of the other companies that they're competing with in their industry, Ford and General Motors. We can see that Tesla has the highest gross profit margin at 25%. They also have the highest net profit margin at 15%, highest return on assets at 17% compared to GM's 3%. Ford is not profitable. And then we can see they have a PE ratio of 47 times earnings compared to GM's 4 times earnings. And Tesla does not pay a dividend. Ford and GM do pay dividends. So from a financial ratio perspective alone, it looks like Tesla is definitely dominating their competition here. They are trading at a way higher PE ratio compared to their competitors, but that might actually be justified considering the fact that they're way ahead of their competitors right now in terms of manufacturing, and they are right now the global leader for electric vehicle manufacturing and production. And to end off the video, I wanted to compare them to some of the other companies we've looked at in past videos. Concerning their share price compared to intrinsic value, we saw that Tesla had an estimated intrinsic value of $43 per share. Right now their share price is $174 per share. So they're trading at around 3 to 4 times their current estimated intrinsic value per share. That's not good enough to get them on the board here. The only companies we've looked at so far that were trading below their estimated intrinsic value were ExxonMobil, GE, ConocoPhillips, and Google. Then on the right-hand side here, we can see in terms of growth rate, Tesla has an estimated growth rate of 10% for the next 5 years compounded annually. That was enough to get them into the 10th place spot on the board here. GE had the highest estimated one at 44% for the next 5 years, according to Yahoo Finance. Then on the right-hand side here, we have their profitability ratios. Tesla's gross profitability and net profitability were 25% and 15%, which is not good enough to get them on the board here. Adobe still has the number one gross profit margin at 89%, and Microsoft has the number one net profit margin at 36%. And lastly, in terms of stock performance over the last 5 years, Tesla has the highest at an estimated, or not estimated, but at 781% for the past 5 years. That's way higher than any of the other companies we've looked at. AMD came in second with 604%, Chipotle with 422%, Eli Lilly, healthcare company that sells insulin, at 313%, and then you can see the rest of the companies on the list here. Tesla definitely has a dominant stock performance over the last 5 years. So based on this, it looks like Tesla obviously returned the most value back to their shareholders. Their profitability ratios weren't doing as good as their competitors, but obviously they could increase their gross profit margin if they wanted to, but they purposefully decreased it in order to put some more pressure on their competitors. And also their net profitability will probably increase as they go to scale, as the article pointed out. In terms of growth rate, they were good enough to get on the board, but they're currently not trading below intrinsic value per share based on this discounted cash flow model. And we saw, compared to the other competitors they have in their industry, they're doing way better from a financial ratio perspective. So a lot of interesting news coming out surrounding Tesla. Obviously, you can see right here that I've bought up a few shares of Tesla here, still keeping my eye on this stock. Let me know in the comment section down below what you guys think of Tesla. Is it a good buy right now at the current share price? Let me know what your thoughts are in the comment section down below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.